Welcome to Beyond Just Money by Kalkinemedia, an independent global media house and investor relations group. Please note that this podcast is for information purposes only. It's not a solicitation or recommendation to buy, sell, or hold the stocks of any company or companies or engage in any investment activity under discussion. Kalkinemedia is neither licensed nor qualified to provide investment advice through this platform.
Hello and welcome to Beyond Just Money. My name is Samta and today with me we have Nidhi Sinha, who is the head of content for Kalkinemedia. Now, the central banks regularly bring about changes in the official interest rates in response to an economic activity. Interest rates are raised when the economy is robust and lowered when it is sluggish. A change in the rate of borrowing can have a ripple effect on the economy. And to discuss that, how do these interest rates affect the stock market? As I said before, we have Nidhi with us. Welcome to the show, Nidhi.
Thank you, Samta. A change in the interest rate does impact the economy and even the stock markets.
Well, that's absolutely right. So could you take our listeners to the stock market and interest rate dynamics?
Samta, investors must understand the impact of changes in interest rates on the stock market to be able to make better financial decisions. This is because higher interest rates tend to negatively impact earnings and stock prices, except for the financial sector. Generally, it takes somewhere between 6 and 12 months for a change in rate to show a widespread impact on the economy. However, stock markets have been known to respond immediately to interest rate changes. Due to this reason, stock market analysts closely track monetary policy decisions.
So what happens when interest rates rise?
Well, when the central bank raises interest rates, the borrowing cost for financial institutions increases automatically. Banks and financial institutions then pass on that additional cost to the customers. As a result, mortgage and credit card interest rates rise, especially in a variable interest rate scenario. This means that consumers then have less cash in hand to spend, which can impact discretionary spending. This further results in lower revenues and profits for companies. Hence, it can ultimately negatively impact earnings and stock prices. Now, the key points to watch out for are that high interest rates negatively impact company profits. Small companies are hit the most. High interest rates bring down domestic participation in stock markets and they slow down growth as well.
Well, that's the scenario when interest rates rise. But again, what happens when the rates are lowered?
The reverse happens in a way, Samta. Borrowing funds can get cheaper when rates are lowered. As a result, consumers and businesses tend to spend more, boosting asset prices. Therefore, the prices of stocks rise. Generally, large companies with stable cash flows and strong balance sheets benefit from cheaper debt financing. However, lower rates can also lead to challenges such as inflation and liquidity traps.
So can we say that interest rate changes have an impact on psychology of the investors?
Yes, they do. As I have already explained, a hike in rates can impact consumer spending, resulting in a company's earnings to fall. It ultimately leads to a fall in stock prices. On the other hand, a cut in interest rates can increase spending and investment from the consumers, resulting in rising stock prices. However, the conventional response may not apply if expectations differ from the actual action of the central bank. So let's take an example. Suppose the central bank is expected to lower interest rates by 50 basis points at its upcoming meeting, and in anticipation, the market factors that in before the announcement. In such a case, when the actual cut happens, it may lead to a fall in stock prices instead of a rise.
Nidhi, globally, which directions have interest rates taken recently and what's the view for the future?
Several emerging markets saw interest rate hikes in June 2021 after hawkish remarks made by the US Federal Reserve raised inflationary pressures in various developing economies. Brazil, Russia, and Mexico were among several nations that hiked the rates. Further, Hungary and the Czech Republic became the first European Union countries to increase interest rates in recent years. The Federal Open Market Committee had decided to keep interest rates up to 0.25% during the meeting concluded on 16 June 2021 due to the economic fallout caused by the ongoing public health crisis. However, the recent jump in inflation breaching Fed's 2% target rate in April and May 2021 triggered several fears regarding a possible interest rate hike. Meanwhile, the encouraging US non-farm payroll data calmed down the ongoing fears to a certain extent. Thus, from an interest rate perspective, it would be interesting to know the outcome of the next FOMC meeting, which is scheduled on the 27th and 28th July 2021.
Thank you so much, Nidhi, for sharing how a change in the interest rates can impact the economy both in a positive and a negative manner with our listeners today.
Thank you, Samta. The FOMC meeting may definitely have an impact on where the rates go forward in the future.
Well, absolutely. Let's see where that goes. And on that note, thank you for coming once again. And to our listeners who want to listen to this podcast again, please log on to our website, that is kalkinemedia.com, or you could also subscribe to our YouTube channel. Please don't forget to like, share, subscribe, and hit that bell icon to get notifications on the latest videos and podcasts. Until we see you next with yet another insightful episode of Beyond Just Money, this is me, Samta, saying goodbye, and stay apprised and invest wise with Kalkine.
Our listeners are requested to make their own inquiries about any investments, and Kalkine Media strongly suggest that the listeners seek advice from a financial advisor, stockbroker, or other professional as necessary. Kalkine Media hereby disclaims any and all the liabilities to any listener arising from any use of the information shared or discussed in this podcast. This podcast is available for personal and non-commercial use only.